Well, the difference is going to be huge. So, I mean, from the beginning, Nelson clearly demonstrates and supports the fact that your need for finance is greater than your need for death benefit, right? The life insurance industry and all of financial planning has focused on the death benefit of life insurance, and rightly so. If you have an obligation, I've said it before, a family or whatever the case may be, you should address that obligation, right? So if I die, right, my wife, my family, they lose me, and then they lose all my future income, right? So that life insurance, the death benefit of life insurance just represents that future income, net present value of future income, right? Okay. So, and that's also why life insurance is not an investment. It's a replacement of a loss, right? If you wrecked your car, and had a $10,000 claim on that accident, you wouldn't get a 1099 from that insurance company on that $10,000 claim. Why? It's not income. It's a replacement of a loss. Well, if I die, the death benefit comes in tax-free to my wife. Why? It's not an investment return. It's a replacement of a loss. All right, that's very important, very fundamental, but it's extremely important. Okay, so the financial world has always focused on the death benefit of life insurance. Nelson, and his story is in his book, his first book, Becoming Your Own Banker, how he discovered the concept. Was under tremendous pressure, right? So once the need for death benefit is solved, when you understand or see that your need for finance is incredibly great, the policy structure difference between an IBC policy and a typical life insurance policy is going to be the focus. One typically focuses on the death benefit. The infinite banking concept focuses on cash value, so you can address your need for finance. So on a typical life insurance policy, if say a 40-year-old male paid $20,000 in premium, he might have $750,000 in death benefit day one. But at the end of the year, he might have $2,000 in cash value, maybe. Right? And then the death benefit grows and the cash value grows if he continues to pay the premium. And $20,000, the same guy with an infinite banking structure, he'll wind up with less death benefit, maybe $400,000, $450,000 in death benefit, but he'll wind up with, $15,000, $14,000, $15,000, $16,000, whatever it is in cash value. And he's going to have a larger dividend forever. Now, an interesting thing, Ryan, about that, I found in my practice that whenever you structure life insurance for the infinite banking concept, you typically wind up with more death benefit at natural mortality than otherwise when seeking to put death benefit in force with permanent life insurance. We go out to natural mortality. We're solving for cash with the infinite banking concept. At natural mortality, the infinite banking concept policy winds up oftentimes with more death benefit